3 years ago, a guy named David sat across from a mortgage officer at a regional bank. He had steady employment, zero debt besides one car payment, and money saved for a down payment. He thought he was prepared. The loan officer pulled his credit score, 608, and the conversation changed completely. David qualified technically, but the rate he was offered would cost him an extra $190,000 over the life of the loan compared to a neighbor who bought the same style home on the same street. Same neighborhood, same bank, different number. David asked what he could do. The officer said, and this is almost word for word what he remembers, "Just keep doing what you're doing. It takes time." What that officer did not mention is that the credit scoring system has a set of very specific mechanical levers, and if you know where they are, time compression is entirely possible. David eventually found out. He rebuilt his score by 130 points in under 4 months using what I now call the 5% system. Not because it requires 5% effort, but because the entire strategy hinges on one critical utilization threshold most people never hit. By the end of this video, you'll understand exactly how that system works and why the financial industry has very little incentive to ever explain it to you. If that kind of strategic financial clarity is what you're here for, subscribe now. Because the next video I release builds directly on this one, and missing it will cost you more than just curiosity. Let me start with a question most people get wrong. What is a credit score actually measuring? Most people say it measures how responsible you are with money. That answer feels right, but it is fundamentally incorrect, and that misunderstanding is the reason most people approach credit improvement the wrong way. A credit score is a statistical prediction. That is its only function. Specifically, it is predicting the probability that you will become 90 or more days late on any debt obligation within the next 24 months. The algorithm is not rewarding responsibility. It is calculating risk for lenders. It is a tool designed by banks to make pricing decisions about you as a borrower. Once you understand that, everything changes. If the score is a statistical model, it follows statistical rules. And statistical rules are not mysterious. They are knowable, consistent, and optimizable. The system is not some opaque black box controlled by forces beyond your reach. It is a formula with defined inputs. Change the inputs strategically, and the output changes. The problem is that most financial advice treats credit improvement like a character development journey. Be patient. Be responsible. Wait for time to do its work. That framing serves lenders. It does not serve you. The longer you stay in the fair or good credit tier rather than excellent, the more interest revenue you generate for every financial institution you do business with. A borrower carrying a 680 score is a more profitable customer than one carrying a 780 score. Same person, same bank, different knowledge. That is the invisible tax that most men in your position are still paying every single month without realizing it. So, let's talk about the most powerful input in that formula, and the one almost nobody uses strategically. Here is a question worth sitting with. What if you could age your credit history by 15 years without waiting 15 years? Here is what the credit scoring model actually calculates when it evaluates the length of your credit history. It looks at 3 things: the age of your oldest account, the age of your newest account, and the average age across all accounts combined. This factor represents approximately 15% of your total score. Most people assume it is fixed. You opened your first credit card at 22. You are now 40. So you have 18 years of history. That is that, but that assumption is wrong. And the error in that assumption is where the 5% system begins. When you are added as an authorized user on another person's credit card account, that account's full history imports to your credit report. The age of the account, the payment history, the credit limit, and the utilization all appear on your report as if you had always been part of that account. If your father has a credit card he opened in 2001 with clean payment history and a balance that never exceeds 5% of the limit, and he adds you as an authorized user this week, that 24-year-old account appears on your credit report within the next 1 to 2 billing cycles. Your average account age could shift dramatically in a matter of weeks. Not years, weeks. This is not a glitch. It is not a loophole in the illegal sense. FICO and VantageScore both incorporate authorized user accounts intentionally. The mechanism was originally designed to help spouses establish credit when one partner managed all household finances. But the principle extends to any trusted relationship: parents, adult children, close family members. The credit bureaus have seen no compelling reason to restrict it because it reflects a genuine financial relationship. Banks know this exists. Mortgage brokers know it exists. Credit repair firms charge people significant money to access networks of strangers with old accounts for this very purpose. But the bank sitting across the desk from you at your initial mortgage consultation has no incentive to tell you that your uncle's 1998 Visa card could transform your credit profile in 60 days. Now let's address the second lever in the 5% system, because this one is hiding in plain sight and affects every single person watching this video. Here is the question. If you pay your credit card in full every single month and never carry a balance, is your utilization low? The answer might be no, and that might be quietly destroying your score. Credit utilization accounts for approximately 30% of your credit score. It is the ratio of your current balances to your total available credit. The widely repeated advice says keep it under 30%. Better advice says under 10%. The 5% system targets between 1 and 3%, and here is why that distinction matters far more than the number alone. Your credit card issuer does not report your balance to the bureaus on the payment due date. They report it on your statement closing date. These are two different dates, and the gap between them is where most financially responsible people unknowingly damage their own scores. Say you use your credit card for $3,000 of normal monthly expenses on a card with a $5,000 limit. You pay it in full every month. Never a single dollar of interest charged. But if that $3,000 balance is sitting on the card when the statement closes, the bureaus see 60% utilization. Your score is being penalized for responsible behavior because of a timing misalignment. The mechanical fix is precise and costs you nothing. Move your payment to a few days before your statement closing date rather than before the due date. Drop that balance to under $150 before the statement closes. You will report utilization under 3%, and your score will reflect that improvement within a single billing cycle. This is the core of why the 5% system is named what it is. The optimal reported utilization sits at or below 5% across all accounts. Not because 5% is a magic number, but because the research on score optimization consistently shows diminishing returns below that threshold and meaningful score compression above it. People who implement this single change, without touching anything else about their financial behavior, routinely see 20 to 40-point increases within 30 days. Now combine that with the authorized user strategy, and you are beginning to see how a 100-plus point movement in under 90 days becomes realistic rather than exceptional. Here is where most people stall. They do the first two things, they start seeing results, and then they unknowingly work against themselves with the third lever. Ask yourself this: when did you last request a credit limit increase on any of your existing cards? Because utilization is a ratio, you can move the number in two directions. You can reduce what you owe, or you can increase what you are allowed to borrow. Most people only ever focus on the first side of that equation. The second side is often faster, completely free, and has zero negative impact on your score if done correctly. Many major credit card issuers, and American Express is the most well-known for this, allow you to request credit limit increases using a soft inquiry. A soft inquiry does not appear on your credit report. It does not affect your score. You simply log into your account, request an increase, and in many cases the approval is instant or within a few days. If you are carrying $2,000 on a card with a $6,000 limit, you are sitting at 33% utilization. Get that limit raised to $12,000, and without changing your balance at all, your utilization drops to 16%. Add the timing strategy from what we mentioned before and pay that down to under $300 before the statement closes, and you are now showing 2.5% utilization on a card that was damaging your score last month. The optimal cadence for limit increase requests is every 6 to 12 months per card. Over the span of 2 to 3 years, someone who started with $12,000 in total available credit across all cards can realistically accumulate $40,000 to $60,000 in limits through incremental requests alone. This matters not because you intend to carry those balances. It matters because the ratio improves continuously, and your score reflects that improvement. Banks do not advertise this option. You will not receive a letter encouraging you to request a higher limit. That would mean lower utilization for you and lower interest revenue for them. You have to initiate it, and now you know too. This next chapter is where strategy separates from tactics and where the 5% system produces results that compound rather than simply add up. Here is the question worth asking before we go further. Are you executing these strategies in the right sequence, or are you accidentally undoing your own work? The most common mistake people make when optimizing credit is executing strategies in parallel without understanding which ones conflict. The authorized user addition increases your average account age. But if you simultaneously open a new credit card to increase available credit, you drop your average account age, potentially erasing the benefit you just gained. Hard inquiries from new applications temporarily reduce your score by 5 to 10 points each. 3 applications in 90 days can cost you 20 to 30 points right when you are trying to build. Optimizing one lever while damaging another is exactly how people spend 6 months working on their credit and end up exactly where they started. The proper sequence in the 5% system is this. First, pull all 3 credit reports and identify any errors. Inaccurate information needs to be disputed before you build on top of it. Second, add authorized user accounts to establish history depth. Third, implement the statement timing strategy to drive utilization below 5% on all reported balances. Fourth, request limit increases on existing accounts only, no new accounts opened during this phase. Fifth, and only after the previous 4 steps have had 2 full billing cycles to be reflected in your reports, evaluate whether any additional accounts or actions make sense. This sequence avoids self-interference. Each step reinforces the one before it rather than working against it. The people who follows this order patiently for 90 days will see a fundamentally different result than the one who attacks all of it simultaneously out of urgency. And speaking of tools that support strategic sequencing, this is exactly the kind of decision architecture that the Trip to Wealth Command Center is being built to handle. It is a Google Sheets that allows you to control your income, spending, and net worth tracking into a single strategic dashboard. It surfaces money leaks, shows where small adjustments compound into real wealth, and gives you a clear view of how your money strategy connects to your broader financial picture. If you want early access at a supporter discount, the link to join the waitlist is below. Every serious wealth-building system needs a control center. This is where yours starts. Drop the word system in the comments right now if you want a reminder when it launches. That one word tells me you are serious about implementation, not just information. Now let us talk about what happens when all of this converges at the most financially consequential moment of your life, because that is where the real money lives. What is the difference between a 720 credit score and a 780 on a $400,000 mortgage? The answer is not a small number. On a 30-year fixed mortgage at today's rates, the spread between the rate offered to someone in the good tier versus someone in the exceptional tier can be 0.5 to 0.75 percentage points. On a $400,000 loan, that difference translates to approximately $180 to $220 per month in additional interest payments. Over 30 years, that is between $65,000 and $79,000 in extra interest paid to the bank. For context, that number is larger than most Americans have in their entire retirement accounts. That is what the difference in score costs in a single real estate transaction. Now consider that most people in the 35 to 55 age range will face at least one major mortgage decision in the next decade: a refinance, a move up, a rental property purchase, a second home. Each of those transactions is repriced based on your score at the time of application. The 5% system is not about gaming a number. It is about ensuring that number accurately reflects your actual creditworthiness and not an artificially depressed version of it caused by timing errors, thin file issues, or mechanics you were never taught. There is also a mechanism available specifically within the mortgage application process called rapid rescoring. This is not something you can access directly. Your mortgage lender can request it on your behalf. When you have made improvements, paid down a balance, been added as an authorized user, the lender can submit documentation to the credit bureaus and have those changes reflected in your score within 72 hours rather than waiting for the next billing cycle. This means that if you are in the middle of a mortgage application and you implement the 5% system strategies in coordination with your lender, you can see score improvements reflected before final approval. Knowing this exists changes how you time your credit optimization. You do not need everything perfect 6 months before you apply. You need to understand the sequence well enough to execute it in the right window, and you need a lender willing to use rapid rescoring as part of their process. Ask for it by name. Most borrowers never do. Here is the philosophical truth underneath all of this. And it is worth saying directly because it reframes everything you have heard about credit throughout your life. The credit scoring system was not built to help you. It was built to help lenders make pricing decisions about you. The complexity of the system, the slow, conventional advice, the patient waiting, all of it serves institutional interests over consumer interests. The authorized user mechanism exists. The utilization timing opportunity exists. The limit increase pathway exists. None of these are secrets in the technical sense. They are all publicly documented in the credit bureau guidelines. They are all fully legal. They are all entirely within the rules. The only thing keeping most people from using them is that no one with a profit motive has any incentive to explain them clearly. That is what today was about. Let me close by walking you through the full 5% system in a single sentence per element so that you leave with a clean, usable mental framework. 1. Understand that credit scores are statistical predictions, not character judgments, and they follow mechanical rules that can be optimized. 2. The authorized user strategy allows you to import decades of credit history from a trusted family member, compressing what would take years into weeks. 3. The statement timing strategy means paying your balance down before your statement closing date, not your due date, so you report utilization at or below 5% on every account. 4. Requesting credit limit increases on existing accounts every 6 to 12 months improves your utilization ratio through the denominator, not just the balance side. 5. Executing these strategies in the correct sequence prevents self-interference and compounds gains, rather than trading one improvement for another. The philosophical reframe worth carrying with you is this: financial outcomes in America are not distributed randomly. They follow knowledge. The gap between a 680 and a 780 is not a gap in character or discipline. It is almost always a gap in information. The system rewards those who understand its rules and penalizes those who trust the simplified version they were handed. Your action challenge is this. This week, identify one family member with a credit account older than 10 years and a clean payment history. Have one conversation. Ask to be added as an authorized user. That single action could be worth tens of thousands of dollars over the next decade. Then pull your most recent credit card statement, find the closing date, and set a recurring calendar alert to pay down your balance 3 days before that date every single month. 2 actions. This week, not next month. Disclaimer: this video is for educational purposes only and does not constitute financial or legal advice. Individual results vary based on personal credit history and circumstances. Always consult a qualified financial professional before making significant financial decisions. This is Trip to Wealth, where strategic clarity meets real financial outcomes. If you found value today, I highly recommend watching my next video. Do not forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below. I appreciate your support more than you know. Until next time, stay consistent and stay winning. See you in the next one, Money Magician.